Your mortgage payment hasn't changed in 3 years, but your neighbor just dropped theirs by $400 a month. Same neighborhood, same loan size, same bank. The difference isn't luck. It's that they knew 2 things you weren't told: exactly when to move and exactly what to say when they called. Most homeowners sit passive while thousands of dollars in savings expire every single year, not because refinancing is complicated, but because lenders have zero incentive to walk you through the timing. That ends today. By the end of this video, you will know the exact break-even calculation lenders don't volunteer, the negotiation script that unlocks rates lower than your initial quote, and the equity acceleration move that can shave years off your mortgage without increasing your payment by $1. Here is the break-even rule every savvy homeowner should know. Take the total closing costs of your refinance, typically 2 to 5% of your loan balance, and divide that by your monthly savings. That tells you how many months it takes to recoup the cost. If you plan to stay longer than that break-even point, refinancing makes sense. If you are moving in 2 years and your break-even is 30 months, you are actually losing money by refinancing even if the rate looks attractive. In 2026, the rate environment has created a specific window for homeowners who bought between 2022 and 2023, when rates spiked significantly. If you locked in above 6.5% during that period, you should be running break-even calculations right now, not waiting for rates to drop further. Waiting for the perfect rate is one of the most expensive mistakes homeowners make. Now let us talk about the part nobody teaches you: how to negotiate your refinance like a professional. Most people call one lender, get a quote, and accept it. That is leaving thousands of dollars on the table. The correct approach is to get quotes from at least 3 to 5 lenders within a 14-day window. Credit bureaus treat multiple mortgage inquiries within that window as a single inquiry, so your credit score is not penalized for shopping around. Once you have multiple quotes, call your preferred lender and tell them you have a better offer from a competitor. Ask them directly if they can beat it. Lenders have more flexibility than they initially show, particularly on origination fees and discount points. This one conversation can save you hundreds to thousands in closing costs. There is another negotiation lever almost no one uses: asking for a no closing cost refinance. The lender covers your closing costs in exchange for a slightly higher interest rate. Whether this makes sense depends on your break-even timeline. If you are uncertain about how long you will stay in the home, a no closing cost refinance eliminates your downside risk. Let us also cover the types of refinance available. A rate and term refinance adjusts your rate or loan term. A cash-out refinance lets you tap home equity. And a cash-in refinance, the hidden gem, involves bringing money to the table to lower your balance, qualify for better rates, or eliminate PMI. If you are still paying private mortgage insurance on a loan where you have built meaningful equity, a reappraisal or cash-in refinance could eliminate that cost immediately. On a $400,000 loan, PMI runs $150 to $250 monthly. Eliminating it is like an instant raise. Now here is where strategy gets powerful: using your refinance to accelerate equity building. Refinancing into a shorter term changes your amortization in your favor. If you are 10 years into a 30-year mortgage and refinance into a 15-year at a lower rate, your payment may stay roughly the same while equity builds dramatically faster. Another approach is to keep your payment the same after refinancing to a lower rate. If your payment drops $300 a month, keep paying the original amount. That extra $300 hits principal directly every month, and over 10 years can shave 4 to 6 years off your loan. Let us talk about timing your refinance around the calendar, because this is a detail most financial content never covers. Mortgage rates are not static. They move daily based on bond markets, Federal Reserve signals, and economic data releases. The best days to lock a rate are typically Monday or Tuesday, before the week's economic data has had a chance to push rates in either direction. Fridays are often the worst time to lock, because lenders sometimes add a risk premium for holding a locked rate over the weekend. Beyond the weekly cycle, watch for Federal Reserve meeting dates. In the weeks leading up to a Fed meeting, rates often move in anticipation of what the Fed might do. If the market expects a rate cut, lenders may preemptively adjust. If the Fed signals a hold or a hike, rates can spike quickly. Understanding this cycle lets you position your rate lock strategically rather than randomly. Here is a tactic experienced real estate investors use, but most homeowners never consider: the float-down option. When you lock a mortgage rate, you are protected if rates rise, but you miss out if rates fall further. Some lenders offer a float-down option that allows you to capture a lower rate if the market moves in your favor during your lock period. It typically costs a small fee, but on a large loan, it can be well worth it if rates are volatile. Now let us shift to home buying strategy in 2026. If you are in the market to buy, the negotiation landscape has shifted. In many markets, inventory has increased compared to the 2020 to 2022 period, which means buyers have more leverage than they have had in years. But most buyers are still negotiating like it is a seller's market, and that is a costly mistake. When making an offer in 2026, seller concessions are back on the table. This means you can ask the seller to cover a portion of your closing costs, buy down your interest rate with discount points, or contribute to a rate buy-down on your behalf. A 2-1 buy-down temporarily reduces your interest rate by 2% in year 1 and 1% in year 2, lowering your initial payments while you build income or wait for rates to drop further before refinancing. One of the most underused negotiation tools in home buying is the inspection contingency leverage. Once your inspection comes back, you have a legitimate opportunity to renegotiate the price or request credits for any identified issues. Experienced buyers use this strategically, not to back out, but to negotiate a lower price or repair credits that can fund improvements that build equity quickly. Equity building through strategic improvements is the final piece of this puzzle. Not all home improvements return equal value. Kitchen and bathroom updates, adding usable square footage, and improving curb appeal consistently return the highest percentages. But the real strategy is timing those improvements to support either a refinance appraisal or an eventual sale. Before a refinance appraisal, focus on anything that increases your appraised value above your investment cost. Fresh paint, updated fixtures, and clean landscaping cost relatively little, but signal to an appraiser that the property is well maintained. On a $400,000 home, a higher appraisal of even $10,000 to $15,000 can push your loan-to-value ratio into a better tier, potentially unlocking a lower rate. The big-picture strategy is treating your home not just as a place to live, but as a financial asset that requires active management. Most homeowners are completely passive. They set up autopay and forget about their mortgage for 30 years. The homeowners who build real wealth through real estate revisit their mortgage every 2 to 3 years, stay aware of their equity position, and use every available lever to optimize their cost of ownership. If this video gave you at least one new idea worth exploring, hit the like button. It genuinely helps other people find this content. Subscribe to Daily Money Mindset for 3 videos every week on advanced strategies that actually move the needle on your financial picture. Drop a comment below. Are you currently in a refinance window, or are you waiting for rates to move? Links to refinance calculators and rate comparison tools are in the description below.